I am here to help you learn the things that I didn't know and I wish I would have known before I invested into Bali. I love investing into Bali. I love the whole idea of having multiple homes around the world. So I would love to have other people in this journey doing the same things and having multiple homes in Bali, around the world, if this floats your boat. And this podcast is there to just help you navigate the Bali opportunity. Okay, great. So we're going to move into the next big question. We're going to cover tax, Terje, so tax for foreign investments, because a lot of people for the last 3 to 5 years to 10 years, but mostly the last 3 years that have invested are kind of like don't know how to be compliant in their tax. And we kind of covered it a little bit, but let's, so they can just listen to this episode and get what is it that I need to do to be tax compliant as a foreigner, as a homeowner of a villa or a couple of villas. So if I'm buying a villa in Bali, do I need a company?
I would say yes.
Okay. Why is it that my notary is allowing me to buy that land lease for 25 years in my individual name and telling me it's totally fine then?
A little bit difficult for me to answer from a sort of ethical perspective, in the sense that to me the regulation is clear, and like I referred to this meeting on Thursday where that was really clear, and I think the next step from the tourism ministry will be to actually gather consultants and notaries to try to stop this. Maybe it's lack of understanding. Maybe it's also they kind of understand, but they don't want to worry about it, and they are only there collecting their fees, and they'll sort of allow it to slip through. Or sometimes they have legal arguments saying this is allowed under my understanding of the law. There is a massive discrepancy on consultants and lawyers and notaries who, in all fairness, is actually a government representative. Although they have their own independent structure, they are government officials. Okay, so all the people that were allowed to do it in their individual name and they weren't flagged are saying that now they have to have they have to pay a tax in order to move the land over to their own company if they were to establish one. And they're saying now we have to again pay the selling tax from individual to foreign, and that's what's actually stopping them from moving it from here to there. Yeah, I think that's unfortunate, and I think if you look at each individual case, or we can gather maybe enough cases to sort of argue that in the sense that you can argue that the government has granted you this right through the notary and see what happens, but the allowance to then have a sort of pardon or a sunset policy on that may or may not happen. And the easiest way is then, like you say, to have a sale or what we call an inbreng, so it becomes part of your paid up capital. Both of them have a tax implication, and then it's a matter of how you can minimize that in the sense that the lowest possible value that qualifies to take it through.
What about the fact that the beneficiary is exactly the same? I mean, in Australia, when we move from an individual into a company, we can argue that the shareholder is in fact the same. So there actually is no, tax owed because it was paid. It was just this is an addendum almost to become compliant.
Yeah, I think it's a different system, and we just got to accept that, whether we see it as logical or not. Maybe in the future it'll change, but that's just how it is.
Okay, so I buy the villa, right? I'm supposed to be in a PTPMA structure. I may have a tax implication because I need to move from my individual to a company. Everyone's kind of sitting still because they are paying tax through their management company potentially, and they don't know why they need to do this per se. We did cover in our previous podcast why you need to do it, because you are having to pay tax on the profit that you are collecting above the 10% that your management company may be paying. So that's why, because you're avoiding tax by having this. It's like a tax avoidance structure. So, okay, let's go through. So I own this property now. Okay, then I give it to my management company. And are they responsible for paying my tourism tax on my behalf as a foreigner?
the responsibility is always with the owner of the asset, which then should be a PMA, so it has a clear tax subject object structure. But it can be paid on the behalf of that owner through the management company. And then how that is consolidated into your tax consultant or accountant that consolidates all of that and can show the evidence. So both is possible. Just make sure it's paid and you can prove that you have evidence for now. Again, forward, I think the management company will be pushed to actually have to do that to make it easier for the tax authorities to get it quicker and not having to come sort of trickle down through the stream towards the owner of the asset to collect it.
And that is, we're only talking about the 10% tourism tax, which is to the province itself, right? So just the tourism tax, the management company goes to the province and says, for this villa, I will use this NPWPD to give you the tax, right? And should they be doing this monthly? Should they be doing this monthly for all the villas?
Yes.
Okay. And for a foreign investor, that's probably the easiest way, is to get your management company to take care of that. And 10% is on the revenue that is collected that hits the bank account.
Yeah, so yeah.
Yeah,
so then that leads to all the other or the other additional tax aspects, I guess. But yeah.
So can one NPWPD be then covered for multiple villas?
Good question. I think for now, yes. Into the future, maybe there will be a need for an NPWPD related to the asset. But for now, that should be okay. As long as you can show that this was for a specific villa, that specific management company is managing on that particular NIB location.
I know one thing someone listening to this podcast is thinking right now. They're going to be thinking, so Terje, should I just wait for this sunset clause to potentially come and present itself, because there's a lot of discussion and legalization happening, so that if I do it right now and I move from individual to company within this year, I have to pay, a certain tax. What would your recommendation be? Should I just wait a little bit and see what happens, and if a sunset clause comes, or?
I think the tax aspect that you need to look at is the overall taxation. And let's say the management company sits on top of an asset owned by a private foreigner, like in a personal lease. They have to withhold then 20% taxes before they pay the person. And there's a lot of management companies who has a lot of pressure on that, because the tax office can't see that it's been paid, and they're pushing for the management company to pay that, and it's compulsory for them to withhold. If it's a management contract between the PMAs, then that's a service, and to the PMA, then they should only withhold the service charge or the service tax, which is 2%.
Okay.
So there is a less tax pressure, and then you get into the consolidation of the company, and I guess we'll talk about how that works and how your overall tax planning is structured.
Okay. So if it was from PTPMA to a PTPMA or a PT to PTPMA, it's only 2% withheld, and then that receiving beneficiary will have the 10% obligation.
Yeah, so the beneficiary, so they will collect the tourist tax, and then from the balance they will connect a whole and pay another 2% for the service.
And the rest, there's nothing payable for the release to the PTPMA after that?
So the PMA then has its own tax structure, and this is where we're trying to have a conversation with the tax office to consolidate what kind of agreements they will accept. The fear is that the tax burden will be double, in the sense that the collecting entity gets taxed on income, then they drop the money and the PMA gets taxed. So that shouldn't be the case. It should be a company, a joint venture agreement or a management agreement. So it's clear that the portion of the PMA is taxed under its own PLN, possibly VAT, and so on.
What's the 2%?
It's just a prepaid tax on behalf of the receiver.
The other company. Okay. Like a franking credit.
Yeah.
Okay. So the next thing is the long-term strategy, the monthlies, which we've talked about privately. So in order to not pay if you don't pay this 10%, and you can, there's a way that you don't have to pay any 10% on tourism tax, is to instead put your villa into the long-term rental market, which is a yearly or a monthly, where they just pay strategy. And some people are actually winning this way better because they have a fixed income that they get there, and it's kind of, I think, a loophole to be earning like any other property that you have in other overseas markets, is like you're just getting the income. Can you explain what kind of taxes that monthlies have, and if any, and how it works?
So I think the first thing is that you then should not have to pay the 10% NPVPD or the provincial tax. You may have some arguments from the government in the sense that they will distrust that you're actually doing short term, so you need to show them that you're not on the OTAs, you're not doing this, and how they will actually try to enforce and get trust into that, we'll see. From a tax perspective, then you're renting out and you have a 10% final income tax on that. And then the consolidation from there on to your overall PMA situation with maybe depreciation of assets and other expenses that you can deduct from the final then dividend tax. But that is a 10% final income tax to a sublease that you have on long term. The other challenge that we have is that nobody can really say what is long term. And everyone kind of says 30 days and up is long term, 30 days and less is daily. But there is no clear regulation from the Indonesian government, to my knowledge, that clearly stipulates that.
Right. So it's confusing if they're...
I think the norm is now...
If it's from a month and above. Okay. So what is the end tax at the end of the year? So they collect all this income, then they have the depreciation of their lease, depreciation of their building that they can apply. And then at the end, whatever is set as profit is...
So you have the corporate taxation, which we talked about before, where I think now the 0.5% for the first 3 years, that'll disappear because it's not only a abuse and loophole for foreigners, it's an SME or UMKM, as they'll say, Indonesian motivated regulation. So the Minister of Finance is addressing this. There's an enormous abuse also on Indonesian level in every city and region. So that I think will close off. How? I don't know yet, but there are already regulations coming out for that. So that means you end up with a level of 22% profit tax or corporate tax, but you get that discount if your turnover is 50 billion or less, it's 11%. And then this is the important aspect that I think we talked about before, that when you buy a lease, make sure you can show the full investment amount because you can depreciate that.
Yes.
So you actually get that back through a depreciation.
Yes.
And if you have cheated a little bit on the reported value, you don't. So you're losing out and you get a higher profit and therefore more taxes.
Yes, let's cover that. So one of our clients actually came to Terje, and the developer actually approached them and said, look, let's sign another agreement so I can reduce my tax. Let's choose a lower value that you paid me actually X and not Y. And the investor was like, I don't really know why I am doing this. But the developer said to them, well, it's no loss for you, right? It's just like, this is an agreement and it helps me reduce my tax. And then Terje was like, but how is this actually advantaging you? You're going to end up not being able to now depreciate the full amount every year for the remaining of your lease because you're doing this double deal. And if it was audited and looked at in a more deeper level, it would be like, it'd be kind of like a fraud, A, and then B, it's not an advantage to the investor. It's better for the investor to show the full value that you paid, so you can use that amount to depreciate in a normal way.
Yeah, I think the developer normally will use the argument that this helps me to give you a better price. So that kind of drags people into considering it and doing it. From a tax perspective, it's not tax planning, it's tax fraud and avoidance. So I think what we just covered, that it's not beneficial for an investor to do that. And I know we had a conversation on the side of this meeting that I referred to on Thursday with the tax authority. They're now working on a level where they can decide what is actually accepted rental prices depending on land size, build size, and so on, similar to what they do with, construction tax, and also on the buy and sell, where, like, if you're buying a freehold property and converting into an HDB title in a pink zone or something like that, you need what we call a dispenda, or a government approval for that value to be accepted, and that is at the market rate, not the tax value of the property. So right now the tax office is very active. They're very aware of this, and obviously it's a big thing, and one of the reasons for why we see the sort of general enforcement. But they're currently trying to figure out the same structure on leases to have a fair market value and perception.
Yeah, that'll be interesting, because then it's like you don't have to report it. This is like kind of what is expected, and you can just apply this unless you've got a lower thing for whatever reason, because your property had a flood, or but something you can like just that. Go and refer to this. Okay, just like a 0.5% was applied for your income, so there'll be some sort of go refer to this table and you can apply that. So in terms of now summarizing the tax for a foreigner who invested in a villa, as soon as you purchase a villa, you don't have any tax, because your developer or your contractor should pay the tax, because they're the ones that collected the income.
If it's a lease, yes.
Yes, it's different for if you're buying a freehold. Right. You do have a tax, a buyer's tax in the freehold. Thank you for reminding me. Your first tax that you'll pay as a foreign investor for a villa is when you start earning the revenue, and you're looking at about 10% if you're on the Airbnb or Booking.com or daily rentals. If you are doing a monthly strategy, there is no 10% owed at all, so you're getting a benefit there. You'll pay at the end of the year. So after this whole monthly tourism tax has been covered, it comes to the end of the year where you'll have to look at all the revenue you collected, minus all your lease depreciation of the building and the land. Whatever is remaining, you will either pay, if you have a PTPMA, 11% is what we're...
Corporate tax,
corporate tax. There was a 0.5% that may now no longer be in the future. Or if you are owning it solely under your personal name, the reality should be 20%. That's what you are really legally supposed to be paying.
Correct.
Okay. So that's the summary of it. So if you now want to move from your individual into a PTPMA, you can reach out actually to Terje's company at Seven Stones. They can help you structure this so you can minimize the tax, because I know it's painful to accept that you have to, move from here to here and pay it. But I think there's ways that can be structured that can help you out. So that's for the foreigner tax.